Ladies and gents, a warm welcome to our channel Polo Vega. On today's video, we should talk about advanced option trading strategies where we simultaneously buy different options of the same underlying asset with the same expiration date. The idea once again is to handle variables like time decay, implied volatility, and delta in the best possible way that we can. But before moving on to our video, let's look at the disclaimer/disclosure clause. Disclaimer/disclosure clause. The contents of the presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the 14th of a series of interactive videos aimed at educating our viewers about advanced options trading strategies used in various combinations of call and put options with other options or position on the underlying asset. Long straddle. Long straddle refers to a strategy used by an investor when simultaneous buying of a call option and a put option on the same underlying asset takes place at the same strike rate and with the same expiration date. The position is taken when the underlying asset is trading in a range-bound pattern and an explosive breakout of the price is expected to occur without a knowledge of the direction of the explosive move. A long straddle allows the investor to cash in the unlimited profit from the explosive move while the loss is limited to the option premiums paid by the investor at the given strike price within the range. Long straddle profit and loss. In the adjacent price versus profit/loss chart, the green line shows us the P&L from the long core position and the red line shows us the P&L from the long put position. X is the strike price and the long core starts making money if the price breaks out to the right, and the long put starts making money if the price breaks out to the left. Since we are buying two options, the break-even point is our distance of X plus the sum total of two premiums paid if the price moves to the right, and our distance of X minus the sum total of two premiums if the price moves to the left. The net effect is the V curve shown by the purple line, which meets the price axis at 2 points, showing the break-even points for the combined trade. Long strangle. In a long strangle strategy, the investor buys an OTM call option and an OTM put option simultaneously on the same underlying asset at different strike prices but with the same expiration dates. In a long strangle as well, the investors expect the price of the underlying to have an explosive move in either direction but are unsure of the timing and direction of the occurrence. These trades could get triggered with a critical news release that could be related to the underlying asset. The loss is limited to the sum total of the premiums paid for both the purchases. Since we are buying OTM options on both sides, the price is usually lower than that of the straddle. Long strangle profit and loss. In the adjacent chart, we can see that the trade becomes profitable only when the price of the underlying explosively moves in one direction, making either the call option or the put option in the money. The trade becomes profitable only when the option is in the money to an extent that I can cover the cost of both the option premiums. Long call butterfly spread. In a long butterfly spread, using call options, we use a combination of a bull call spread strategy and a bear call spread strategy. The two spreads use three different strike prices on the same underlying asset and the same expiration date. The call butterfly can be created by buying an in-the-money call option at a lower strike price, then selling two out-of-money call options, and finally buying an out-of-the-money call option on the same underlying and with the same expiration date. The combination of the debit trade by buying the in-the-money lower strike price call option and selling the AM call option is the bull spread, while the trade involving the selling of the ATM call option and buying of the OTM call option is the bear spread trade. Overall, the long call butterfly spread is a net debit strategy. In a balanced long butterfly spread, the two wing widths are equal, while in others they are not. Unlike the straddle and the strangle, the butterfly strategy works out if the price of the underlying is range bound. Long call butterfly spread option profit loss. From the adjacent chart, we can see that the individual call options combine into a butterfly strategy whereby the trade is profitable if the price of the underlying stays between the lower strike price of the ITM core option and the higher strike price of the OTM core option. The highest profit occurs at the ATM core option strike price. If the price of the underlying exceeds the ITM and OTM strike prices in either direction, then the investor sustains a loss of the net debit amount of the trade. One can see that the profit as well as the loss are both limited. Short put butterfly spread. This strategy is a combination of a bearish put strategy and a bullish put strategy. The strategy is similar to the long core butterfly strategy, is four-legged with three strike prices. It's a direction neutral strategy that tries to take advantage of the increased volatility in the price of the underlying. This strategy involves selling an OTM put option at a slower strike price, followed by buying two ATM put options and then selling an in-the-money ITM put option at a higher strike price. In other words, it's a combination of a long put option spread, the short put option spread. Over and above being direction neutral, the risk and reward are predetermined and limited. Lower break-even point is equal to the lower strike plus net option premium. Upper break-even point is equal to the upper strike minus net option premium. Profit is equal to net premium received. Max potential loss is equal to lower strike price minus middle strike plus net premium received. This is a net credit strategy. Short put butterfly spread, profit and loss. In the adjacent chart, we can see that the trade is profitable when the price of the underlying stays above the higher ITM price or the lower OTM price of the underlying asset. Iron condor. In this strategy, the investor simultaneously holds a bull put spread and a bear call spread. The iron condor is constructed by selling an OTM put option and buying an OTM put of a lower strike, a bull put spread, and selling one OTM call option and buying an OTM call option of a higher strike, a bear call spread. All of the above options are on the same underlying asset and at the same expiry date. Typically, the put and call sides have the same spread width. This strategy allows the investor to earn a net premium in times of the underlying asset's price experiencing low volatility. It's a delta neutral strategy with predetermined limited profit and loss. Construction and profitability of iron condor. The strategy is constructed by selling an OTM vertical put spread below the current market price and selling an OTM vertical call spread above the current market price. The two vertical spreads are bull put and bear call spreads. The bull put strategy aims at allowing the option to expire at a price below the current market price, and the aim of the bear call spread is to allow the option to expire above the current market price. The strategy is based upon low volatility, allowing the current market price of the underlying to stay between the two middle strike prices at expiration. The strategy can be made bullish or bearish from delta neutral position by shifting the middle strike prices below or above the current market price. The bull put spread on its own has a positive delta, while the bear call spread on its own has a negative delta. The maximum profit from the bull put strategy is limited to the net option premium, while the maximum loss is equal to the difference in strike price multiplied by 100 minus the net option premium collected. The maximum profit from the bear call strategy is limited to the net option premium, while the maximum loss is equal to the difference in strike price multiplied by 100 minus the net option premium collected. By combining the two spreads, we reduce the loss from the in-the-money trade, whether bull put if price moves down or bear call if the price moves up, by the net premium of the OTM trade, as one of the spreads will always remain out of the money if the price moves out of the desired range. Iron condor profit and loss. The adjacent chart shows the maximum profit and loss from an iron condor strategy. The trade remains profitable over a wide range between two break-even points on either side, and it runs into a loss if implied volatility goes up and one of the spreads becomes in the money. Max loss remains limited to the difference in the strike price multiplied by 100 minus the total net premium collected. The profit remains limited to the total net premium collected, as it's a credit strategy. Iron butterfly strategy. In an iron butterfly strategy, the investor sells an out-of-the-money put and buys an out-of-the-money put, and simultaneously sells an out-of-the-money call option and buys an out-of-the-money call option. All options are on the same underlying asset and the same expiration date. Although it looks similar to a butterfly spread, but we use both call and put options in the strategy. The strategy essentially combines a short out of the money straddled with two OTM protective wings that could be equivalent to buying a strangle. One can also call it a combination of two vertical spreads, which is an ATM bull spread and ATM bear call spread. Investors usually maintain the same width for both the spreads. The OTM long put option position protects against losses in the downward direction, and the OTM long call option position protects against losses in the upward direction. Max profit is limited to the sum of two option premiums when the underlying current price stays at the money strike price, and profit starts going down when price moves up or down from this position, with max loss occurring at and beyond the OTM strike price of the call option in the upward direction and put option in the downward direction. Max profit is equal to sum of two option premiums. Max loss is equal to difference in strike prices minus the sum of the two premiums. Iron butterfly profit and loss. In the adjacent diagram, we can see that the two spreads result in two break-even points, which are located at ATM strike price plus net premium and ATM strike price minus net premium. Max profit is equal to net premium received, and max loss is equal to difference in strike prices of the largest spread minus net premium. Strategies for sideways markets with low volatility: short straddles, short strangles, and long butterflies. Credit strategies work best in non-volatile to low volatile markets, allowing the option to expire unexercised. We hope that you enjoyed our short video presentation on advanced option trading strategies with the use of various types of vertical spreads and their combinations to take advantage of increase and decrease in market volatility and participate in breakout trades as well as range-bound trades. If you liked our video, please give us a thumbs up and press the button underneath to subscribe to our channel Polar Vega and watch all our videos. You may also visit us at our website www.polarvega.com or get in touch with us through our Twitter handle @PolarVega. We shall take a short breather before we move on to our next segment, where we start talking about various tools that we use to guide us with our entry and exit from various kinds of trades. Before we move on to the next segment, we should talk about various personality traits that may work for us or against us while we trade. Until then, please keep saving, keep investing, and keep getting wealthier until we meet next. We thank you for watching our video, and we hope that you like, share, and subscribe to our channel Polar Vega.